There is a duplex on Callaway Street listed for $52,000. It has 2 units, a cracked driveway, one tenant who pays $475 a month, and one unit that has been vacant for 11 months. The listing says opportunity. That word is doing a lot of work. In the hands of one person, that duplex becomes a side hustle that bleeds cash for 3 years and ends in a quiet sale at a small loss and a lesson they describe at dinner parties. In the hands of another person, the same duplex becomes the first entry on a balance sheet that eventually holds 8 figures. The duplex did not change, the debt structure changed, the control changed, the entity changed, the decision-making changed. That is what this is about. Level 1, you find it. Maybe it is Callaway Street, maybe it is a different street in a different Rust Belt city where the price-to-rent ratio is doing something that doesn't make sense until you look closer. Purchase price $52,000, you put $13,000 down, a small regional bank gives you a 30-year conventional loan on it because you have a W-2, a credit score above 700, and a debt-to-income ratio that clears their threshold. The rate is 7.4%. Monthly principal and interest 270, property taxes 190, insurance 110. You are in at 570 per month before anything breaks. The occupied unit brings 475. The vacant unit, once rehabbed, should bring 625 based on 3 comparable rentals within 6 blocks that you found yourself and verified with the property manager who charged you 150 for an hour of her time. That 150 was the best money you spent in this process. On paper, the numbers work. Gross rents 1,100. Monthly expenses 570 plus vacancy allowance plus maintenance reserve. There is a number on a spreadsheet that looks like profit. Then you meet the actual building. The rehab scope on the vacant unit comes back at 14,000 from the first contractor. The second says 19,500. The third says 11,200 if you can wait 8 weeks and you absorb the cost of permits yourself. You choose the third. The permits take 4 weeks to pull. The contractor starts on week 6. By week 9, he has completed roughly half the work and submitted a change order for 2,800, citing subfloor rot that was not visible during the walkthrough. It is real rot. You have seen it. You pay the change order. The total rehab lands at $16,900. Your original spreadsheet said $14,000. The difference is not dramatic. It is instructive. Every number in your model was an estimate. Every estimate was optimistic. File that without forgetting it. The loan you signed has your name on it, not an LLC's name, not a trust, your name, a personal guarantee. That signature means the lender can come after your savings account, your car, your wages if this deal fails badly enough. A lot of first-time investors sign that line without sitting with what it means. It changes the decision-making whether you acknowledge it or not. You become less willing to walk away from a bad contractor because losing the timeline costs money you are personally responsible for. You become more likely to absorb a change order you should have contested. The personal guarantee is not just a legal document, it is a psychological contract that attaches the deal to your life. You formed an LLC before closing because someone on a forum told you to. The paperwork cost $200 and took 40 minutes. Here's what the LLC does not do automatically. It does not protect you if you personally guarantee the loan. It does not protect you if you commingle personal and business funds in the same account. It does not protect you if you never drafted an operating agreement, never held it to any formality, never treated it like a separate entity. An LLC is a container. An empty container with no walls is not containment. What actually creates separation is discipline over time. A dedicated business account, clean bookkeeping, no personal expenses running through the property, and a liability policy that actually covers the asset. That combination costs more in time and attention than the $200 filing fee. It is not optional if you intend to build. The vacant unit rents at $600, not $625. The tenant is good, pays on time. You refinance at month 14. The bank orders an appraisal. The appraiser values the property at $71,000 based on net operating income, a capitalization rate for that submarket, and the comparable sales within a quarter mile. You pull $9,200 out. The new loan payment rises to $340 per month. The property still cash flows narrowly. This is your first encounter with the logic that will define every level above this one. Force the NOI higher through better rents or lower expenses. Push the appraised value up. Refinance, extract capital, redeploy it, hold the asset indefinitely. Infinite hold. It sounds clean. The first time it feels like surviving. Your partner asks twice in year 1 why you seem distracted. You pay the plumber on time, the contractor on time, the tenant's repair request within 48 hours. Nobody knows you did that. Nobody sees it. But the property manager who referred you to that appraiser, she noticed reputation at this level is invisible and compounding. The duplex on Callaway Street is not a side hustle. It is a first proof of something. The machine has started. The machine has started. Now you want to build something. That distinction matters more than most people realize when they first encounter it. Buying a property means acquiring something that already exists. Building means creating something that does not exist yet, which requires convincing a city, a lender, a contractor, a neighbor, and eventually a tenant that the thing you're imagining should be allowed to exist at all. Those are very different problems. They require very different skills, and they carry very different consequence. And they It cash flows barely, and the refinance gave you 9,200 to work with. You start looking at your lot differently, or you find another lot, or you find a house with a backyard large enough to support an accessory dwelling unit. In most cities that have updated their zoning in the last 5 years, that conversation is now possible in ways it wasn't before. An ADU, a detached garage apartment, a small studio in the backyard. One additional unit on a lot you already control, or intend to control. This is level 2. It sounds modest. The word modest is doing a lot of work. The difference between buying and building is the word entitlement. An entitlement is official government approval to build a specific thing on a specific piece of land. A building permit is an entitlement. A zoning variance is an entitlement. A conditional use permit is an entitlement. Without entitlements, you have land and a dream. With them, you have a project. The gap between those two things is where a very large amount of money and time disappears, and where the people who survive it separate from the ones who don't. You find a lot on Darien Avenue. It is 6,200 square feet, currently zoned single-family residential. The city has an ADU ordinance, but the setback requirements on this lot make a rear unit complicated. You hire a local land use attorney for 4 hours at $280 per hour. She tells you the variance process takes 3 to 5 months, costs $2,400 in filing fees, and requires a neighborhood hearing. She does not tell you whether you will win. Nobody can tell you whether you will win. You submit the application, you wait. While you wait, the money you have committed is working against you. Not dramatically, but mechanically. The carrying costs on optioned land, on deposits, on pre-development professionals, on your own time pulled from income-producing activity. They accumulate during a period when nothing is being built and nothing is generating revenue. This is called the time value of money problem, and it does not care about your optimism. It runs the clock whether the city is cooperative or not. Option contracts are how sophisticated developers address this before it becomes a crisis. Instead of buying the land outright, you negotiate the right to purchase it at a fixed price within a set window, typically 6 to 18 months, in exchange for a relatively small earnest deposit. You control the land without fully owning it. If the entitlements don't come through, you let the option expire and walk away with a loss limited to the deposit and the soft costs you've already spent. If they do come through, you exercise, you own, you build. The option contract is not a trick. It is a rational allocation of risk during a period of fundamental uncertainty. The seller gets paid for their patience. You get time to find out whether the project is real. The neighborhood hearing on Darien Avenue runs 2 hours. 4 neighbors speak against the variance. One of them says property values, one says parking, one says character of the neighborhood, which means something specific to that speaker and something slightly different to everyone else in the room. You present your case. The board votes 3 to 2 in your favor with conditions. You leave the meeting understanding something that no spreadsheet prepared you for. Entitlements are political. They involve people who do not share your incentives, who are not bound by your timeline, and who have the legal standing to slow or stop the thing you're trying to build. This is now part of your job. The construction loan arrives as a different animal entirely. A construction loan is not a mortgage. It does not hand you a lump sum at closing and walk away for 30 years. A construction loan advances money in draws, disbursements tied to verified progress on the project. The lender orders inspections before each draw. An inspector confirms that the work attributed to the draw request has actually been completed. The lender approves the money moves. If the work is not done, the draw does not release. This is called cost to complete underwriting. The lender is not financing what you have built. They are financing what remains to be built and assessing whether your remaining budget is sufficient to finish it. The interest reserve is built into the loan at origination. It is a pool of money that pays the interest charges during construction, so you are not required to service the loan from cash, while the building is not yet generating income. It sounds like a cushion. It is actually a clock. When the interest reserve runs out, construction had better be done or close enough that lease-up revenue is arriving. Projects that run long burn through the reserve and create a gap, a period where you're paying interest from personal funds or renegotiating with a lender who now has leverage over you. Most developers who encounter this gap for the first time describe it as the moment the project stopped feeling like an opportunity and started feeling like a liability attached to their name. Level 3. You have completed the ADU, you have one small refinance, and a growing file of project experience. You start looking at an 8-unit building, maybe 12, maybe a vacant parcel that could hold 24 units if the density pencils. The numbers require more capital than you have. This is the moment the equity partner enters the picture. The equity partner is not a bank. They are a person or a small group of people who contribute capital in exchange for ownership. You contribute the deal, the relationships, the entitlement work, the operational expertise. They contribute cash. The structure has a name. A limited partnership or an LLC with clearly defined classes of membership. The person who found the deal and manages it is the general partner or managing member. The person who wrote the check is the limited partner or passive member. These roles carry different rights, different obligations, and critically different exposure. The operating agreement defines everything that matters. Who makes decisions? What decisions require consensus? What fees the managing member earns for originating the deal, for managing construction, for managing the asset once it is stabilized? What return the limited partner receives before the managing member participates in profits, that threshold is called the preferred return. It is the limited partner's floor, everything above it is negotiated, the split above the preferred return is called the promote. A typical structure might read as 60% to the LP, 40% to the GP after a 7% preferred return to the LP. That sentence is simple, the relationships it governs are not. Because the moment the project encounters a problem, which it will, the question of who controls the checkbook, who can fire the contractor, who can decide to sell or refinance or wait. Those questions answer themselves by referring to the operating agreement you either drafted carefully or didn't. Pre-leasing is where the underwriting either holds or falls apart. Before the building opens, you are projecting rents based on comparable properties in the submarket. You hire a broker who pulls data, identifies concessions that competing buildings are offering, models absorption, which is the rate at which vacant units fill, and tells you how long you should expect to reach stabilized occupancy. Stabilization is typically defined as 93% occupancy sustained. Your lender will not refinance into permanent debt until you hit it. Your equity partner will not see their full return until you hit it, and you will not take your development fee, the fee you deferred during construction, until the numbers justify it. One wrong assumption in the rent comps wipes the model. If comparable buildings are offering 6 weeks of free rent as a concession and your model assumed 2, the effective rent is lower than you underwrote. If absorption takes 9 months instead of 5, your interest reserve runs out before you stabilize. If rents softened in the quarter between underwriting and opening because 2 other buildings delivered simultaneously, you are chasing a moving target with a fixed cost structure. These are not exotic scenarios. They are common enough that experienced developers build stress tests into their models and still get surprised by which variable breaks first. And then there is the consequence no one discusses until it is unavoidable. At level 3, your name is on public record in ways it was not before. The variance hearing, the LLC filing, the construction permit, the deed, the entity documents. If this project fails, if the lender forecloses, if the equity partner sues over a disputed decision, those records are searchable. Your name and your project and its outcome will be associated in ways that follow you into the next deal.
The brokerage community knows. The small balance lenders know. The subcontractors talk to each other. Reputation at level 2 was invisible and compounding. At level 3, it becomes explicit collateral. You are not just the person managing the project. You are the person the project reflects. The entitlement cliff is real. Most people who try to climb it underestimate how long it takes and overestimate how much goodwill they have accumulated with the city, the neighbors, and the capital. The ones who get to the other side didn't get lucky. They modeled the timeline honestly, controlled land before they owned it, understood every clause in the operating agreement before they signed it, and treated the public record as something that would outlast any single deal. The machine is still running, it is heavier now. You have survived the entitlement cliff, the machine is heavier and you have kept it running. Now the question changes. It stops being can you execute a project and starts being can you run a platform. Level 4, you are not managing one deal, you are managing 3 simultaneously, each inside its own special purpose vehicle, its own LLC, its own bank account, its own set of investor relationships. The SPV structure exists for a reason. It ring-fences liability. If one project fails, the failure lives inside that entity and does not automatically contaminate the others. That is the theory. The practice is that your name is the personal guarantee on all 3 construction loans, which means the ring-fencing protects your investors from each other, but does not protect you from any of them. The shared back office emerges out of necessity. An accounting firm, a construction manager who floats between projects, a paralegal who processes entity documents. The overhead is real and it runs whether the projects are generating revenue or not. What you're selling to capital partners at this level is not a single building. It is execution certainty. The ability to deliver on time, within budget, with documentation that survives an audit. That is the product. The buildings are how you prove the product exists. The contractor relationship becomes critical in a way it wasn't before. A guaranteed maximum price contract caps the contractor's reimbursement. You know the ceiling? A cost-plus contract does not. The contractor bills you for whatever the work costs and adds a fee on top. In a rising materials environment, cost-plus transfers risk to you in ways that can quietly destroy a pro forma built during a different cost environment. Schedule penalties, liquidated damages written into the contract, exist to align incentives. They also generate claims. A subcontractor defaults on the framing package, and the general contractor blames the owner for a site condition. They say they weren't disclosed. The insurance carrier investigates. The project pauses. The interest reserve clock does not pause with it. Net operating income is not discovered.
It is manufactured. The lease strategy determines tenant quality, lease duration, and the rent roll stability under stress. A building with 10 tenants on month-to-month leases looks identical on the exterior to a building with 10 tenants on 3-year leases. It is not identical to a lender underwriting a refinance. Operating expenses are the other side of the equation, and they are where optimistic projections go to die. Management fees, insurance increases, property tax reassessment after a sale, maintenance that deferred itself during lease-up and arrived all at once. A pretty building in a good location with a poorly managed operating expense line is still a bad deal. The NOI determines the valuation. The valuation determines everything downstream. Refinancing, recapitalizing, or selling is how liquidity reappears without a sale. You refinance into permanent debt at stabilization, pull out equity, return capital to your LP, reset the preferred return clock, and retain control of the asset. The investors receive their capital back, you retain the equity upside, you appear to have cashed out, you did not cash out. You manufactured a liquidity event while keeping the compounding engine running. This is not a trick. It is the fundamental mechanism by which experienced developers build balance sheets that look much larger than the equity they originally deployed. Cost segregation studies accelerate depreciation by reclassifying building components into shorter useful lives. Bonus depreciation changes under recent tax law have altered the math significantly. Passive loss limitations mean those paper losses may be suspended against future income depending on your classification as a real estate professional. The tax strategy is inseparable from the capital strategy. The paper loss is not incidental. It is designed level 5. You are looking at a mixed-use project, 100 to 300 units with retail or office below, and the capital stack now includes preferred equity sitting between the senior loan and the common equity, and mezzanine debt above the senior with its own covenants and its own cure rights. Waterfalls define who gets paid in what sequence under what conditions. The complexity is real. So is the fragility. A preferred equity holder who is technically a lender in most scenarios can move against the asset faster than you expect if a covenant trips. Lawsuits arrive at this level not because you made obvious mistakes, but because the structure created disagreement that the operating agreement could not fully anticipate. Grantor The uncomfortable truth is that growth at this level can increase personal risk faster than it increases personal wealth. The balance sheet looks impressive. The exposure behind it is something only you and your attorney fully understand, and the machine, heavier than ever, is still running. The machine does not stop, it scales or it stalls, and at a certain point, scaling requires a category of capital that operates on entirely different terms. Level 6, you are no longer finding deals. You're raising trust. Pension funds, insurance companies, sovereign wealth allocators, family offices with 9-figure mandates, these entities do not respond to a pitch deck with renderings. They respond to track record documentation, audited financials, institutional-grade reporting infrastructure, and the answer to a question they will not ask directly, but are always asking. If you disappear tomorrow, does the platform survive? The relationship is the underwriting. Your reputation is a balance sheet input. A family office managing generational capital does not deploy into a project. They deploy into a person's demonstrated judgment over a decade or more. Patient capital has a different cost and a different expectation. It tolerates longer timelines. It does not tolerate opacity. The governance requirements arrive with the check: quarterly reporting, independent board representation. Keyman clauses that give investors the right to exit or restructure if you die, become incapacitated, or are named in certain categories of legal action. Your identity and the platform's identity are legally intertwined, and that entanglement is now a documented risk factor in the fund documents. The control architecture at this level is a structure of structures. Co-GP agreements where a capital partner co-sponsors the deal in exchange for fee participation. JV agreements where an institutional partner provides 70 to 90% of the equity and retains approval rights over major decisions. The fee streams, acquisition fees, asset management fees, development fees, disposition fees are real and recurring. They also create alignment questions that sophisticated capital will interrogate. Who gets paid first when the project underperforms? The answer is in the waterfall. The waterfall is in the operating agreement. The operating agreement is 40 pages long, and your LP has their own attorneys who read every line. Politics is no longer background. At this scale, you're visible in the community, and visibility is a liability you manage. Lobbying relationships, community benefits agreements, affordable housing set-asides that were once optional and are now the price of zoning approval. Legal teams that exist to move fast and to stop others from moving against you. A single organized opposition group, a local council member in an election cycle, a news story about displaced residents can pause or kill a project that took 4 years to entitle. The reputational cost of a public failure at this level does not stay in one zip code. Liquidity is still not what it appears. A portfolio valued at $1 billion on paper requires a buyer, a refinancing market, or a public vehicle to convert that number into cash. Portfolio sales, recapitalizations, REIT conversions, none of these are guaranteed, and none of them are fast. Paper wealth is real wealth that is not yet money. The distinction matters when rates move, when credit tightens, when a major tenant vacates, when the exit you planned for year 7 is now year 11 and your LP agreement did not fully anticipate the extension. Succession is the final test. The developers who built durable platforms eventually separated their name from the machine. Professional management hired before they were needed. Institutional governance installed before an investor demanded it. The founder's judgment embedded in systems rather than held privately in one person's head. Dynasty collapse usually does not come from a bad deal. It comes from a founder who could not let the platform become something larger than themselves. Here's the lens. When someone presents a real estate development story at any level, ask 4 questions. Where does control actually live? Who signs the personal guarantee? Who gets paid first when the deal is stressed? And what does the exit require that does not yet exist? The answers tell you more than the renderings ever will.